Hi, this is Patty, the loan designer. Today, I want to talk about another type of construction lending. So you're building your dream home, and your builder is going to customize it exactly to you and your family. What that means is they're going to most likely have you carry the financing on that. That financing product that you want is called a construction loan, an interim loan, or mechanics loan, and those are all interchangeable words depending on who you're talking with. So we're going to do something called a one-time close. We will go through the details and the cost in our financial presentation, but here's what that is. We take the land, we take the cost to build during the build, and we take the permanent 30-year fixed or whatever type of program you're getting, and we squish it all into one. That is mortgage term for a one-time close. So it is the entire from land to when your home is completed, wrapped into one loan, and that's why it's called a one-time close. You go to the title company one time. It's one loan number, and it is one set of fees. And what happens is that interest rate is locked up front, and then at the end, you float down to the best rate on the market. Now, if rates go up and your rate is locked up front before you break ground, then that interest rate cannot go up. It's a one-time close. And what happens at the very end, you're going to do something called modify. So when you have a one-time close, and let's say you break ground in January, and your home is going to be complete in December, a couple things occur. On the mortgage, it's interest only. And when your loan is modified, it gets converted to principal and interest. That makes sense, right? Then what happens? If the rates get better, we can float down or drop the rate. Well, we don't want a higher rate, we want a lower rate. So also at modification, we are going to set that interest rate for you. Now, when it was just a lot, we probably got a home insurance quote, but you don't need to pay home insurance when it's just dirt. So we're going to get a copy of your insurance quote, and you'll need to pay that in advance. So you'll pay that out of pocket and send us proof that your home insurance is in force. A couple other things we do. We're going to set the property taxes because in January, your home is completed in December. We're not going to know exactly what the property taxes are because the county assessor is going to go out sometime in June to September and assess that year's taxes. So we'll collect any taxes or escrows at modification. The last thing that we're going to do is we're going to set that final loan balance. Let me give you an example. Let's say you borrow $500,000. And we're going to go through interest, how that is paid and collected while you're building. But we don't know if your builder is going to be done on the 10th of the month or the 20th of the month. So we'll true up the interest that is owed when we modify. And remember, once we modify, and in this example, you move in December, no house payment in January, first house payment due February 1st. We're going to go into all these details when we do our presentation, but this is something called a one-time close, just to give you a little insight on some of the mechanics and details behind the scene. More about this later. Thank you much.